But if you look at the overall profits of UK companies as a share of GDP, excluding oil and gas companies, because they've made a lot of money for obvious reasons, for the rest of the corporate sector, profits have fallen over the last year. And as a share of GDP, they're the lowest since 2009. So the rise in energy prices and in commodity prices more broadly has squeezed household incomes. It's also squeezed company profits.
How big a risk is there that we've already overshot in terms of the rate rises that we've seen? One of the things that stood out in terms of today's decision was, in terms of today's briefing, was what the bank was talking about in terms of the transmission mechanism through the mortgage sector, which is happening more slowly than they anticipated. Is it therefore a danger that we have already tightened too fast because actually the effects of the previous rate rises are still to be felt?
So it's an important point that monetary policy works with a considerable lag. So we've really only just started to feel the effects of the rapid rise in interest rates, which took off from the middle of last year. Obviously, they were raising rates in the first half of last year, but quite slowly. The rapid rises since the middle of last year, the effects of those are only just starting to come through. Have they done too much? I don't think so, but if they have, they can always cut rates a bit next year, and that would not be a bad outcome. So a scenario under which interest rates, let's say that we've had the peak and we're at 4.5, and then they hold for the rest of this year, and then edge rates down a little bit next year as inflation falls, that's not a bad outcome.
Would you have advised the Prime Minister to make his number one priority halving inflation by the end of the year?
Well, I think it's honestly, it's like forecasting that the sun's going to rise tomorrow. It's not something which is under his control. The chances are he's going to meet his target, but he may miss it because of factors like if energy prices were to rise or something. So I think it would be better, really more meaningful, for him to focus on trying to improve people's living standards over a long period of time, because that's something which we haven't had over the last 10 to 15 years.
Well, before the Chancellor's spring budget, you were a strong advocate of childcare reform to try to plug the gaps in the labour market, among other things. Has the Chancellor done enough on that?
I would give him a B-. He answered the question. Right? He introduced measures to try to reduce the costs of childcare. And bear in mind the background to this is that the UK has among the highest childcare costs of any advanced economy.
Yep.
And that's a serious impediment to women's workforce participation and to their career progression. And that harms the economy's ability to grow. So addressing that is an economic priority. So at least he started to tackle that. I don't think he's done enough. I don't think he's put enough money into it. And I suspect that's something which either himself or a future Chancellor is going to have to come back to in coming years.
Well, has either party got an adequate vision for how to grow the economy?
Well, look, over the last 10, 15 years, the UK has sort of been stuck in a low growth rut. And the consequence of that has been little or no growth in living standards. It also means that the Chancellor in his budgets is locked into painful choices of either little or no growth in public spending or rising taxes or both, right? So breaking out of that, I think, has to be a really important priority for the government, this government or a future government. Now, the kind of things you'd look at is childcare, sure, but got to do more. Public investment, education, closer trade links with Europe. Now, there's a big policy agenda there. I think most of the work on that still lies ahead of us.
Nice to see you. Thanks for stopping by.
Always good to be here.
Yep, nice to have you inside. Raining outside quite heavily. We didn't want you to get wet. Great to see you, Michael. Thank you very much indeed. Former NPC member Michael Saunders, and of course, our thanks to Bloomberg's Lizzie Burden. OK, coming up, we're going to get the market's take on the Bank of England's latest move. Caroline Simmons, UBS's Chief UK Investment Officer, joining us next. This is Bloomberg.
so far this year we've had a strong sterling. The UK economy has surprised people. The Bank of England expected us to be in recession now, the UK to be in recession. Most economists did. We expected a recession in the UK last year. We've now upped our forecast. We don't have a recession in our forecast now. So all those things should be helpful for the mid-cap index, the FTSE 250. But it hasn't really outperformed this year, not on the stronger sterling and not on the better economic growth.
That was, of course, Sharon Bell, Goldman Sachs International Senior Equity Strategist, talking to us yesterday about what she's seeing with UK assets. Let's carry on the conversation now. Caroline Simmons, UBS UK's Chief Investment Officer. Get that in the right order, it's quite important. Nice to see you.
Nice to see you.
So the Governor of the Bank of England has today significantly raised its economic forecasts for the UK. It was expecting quite a significant recession. It's now effectively predicting flat growth. Nevertheless, you would have thought that that might be quite encouraging for the FTSE 250. Sharon's point is that it hasn't performed yet. Do you think it will? Is that the switch you want to make from the FTSE 100 into the 250 as the economy maybe does a little bit better than anticipated?
I think it's a little premature to make that switch. As you said, we're talking about growth that's sort of flattish.
Yeah, the level matters.
The level does matter. I mean,
Yeah.
Obviously the change matters, but the level does matter when you're talking about international versus domestic, which is what the 100-250 call ultimately is. The other angle, of course, is to do with oil, and we're quite positive on the oil price still. We've got $100 barrel oil by the end of the year, and therefore that favours the 100. So there are quite a few dynamics. The other thing to think about is banks and financials. Depending on what people's views are on when the rate cuts are going to start to come, how much that would erode the net interest margins of the banking sector, which obviously is more influential for the FTSE 100.
Hey, Caroline, to that point then, if we just take the FTSE 250 for a moment, what kind of growth forecast do you think is currently priced? Like, I hear you that it's like tepid growth, it's like 1%, it's not a big deal, but if we were looking at a recession, that is a meaningful differentiator.
Yeah, I mean, I think, the market has been talking about potential recession, and is it increasing in probability, especially after the banking turmoil stresses in the US. But the reality is that the equity markets are not priced for recession. So, if we now end up with flat growth, that's possibly just about okay in terms of the equity market pricing in Europe. But in the US, I would argue the US equity market is still too expensive for the growth outlook that we are expecting.
Are you factoring in a stronger pound?
Yes, we have slightly stronger pound. We have it rising to 133 by March of 24.
So that's quite a decent amount of upside.
Yeah.
So why a stronger pound but not a stronger 250?
Because it's only one of the factors. You haven't got the additional sort of benefit of, the oil price, the economic momentum. You need a lot of factors to get the 250 to really outperform the 100. And I don't think we're there. And also in terms of global risk sentiment, yes, we're getting sort of further potentially away from recession with all these economic upgrades, but people are still worried about the downside risk rather than the upside risk, and that's not going to make them want to take mid-cap risk exposure.
Caroline, what do you do with gilts? Jamie Dimon, not gilts specifically, but Jamie Dimon was talking how he wouldn't want to touch sovereigns at all.
Anywhere.
Yeah, I think they're reasonably attractively priced. You're getting decent yields. They do provide the downside protection if the economic growth does come in worse. And if it doesn't, then, on the UK, you're getting sort of over 3.5% on a 10-year. I think that's quite reasonable. We have a preference for high-grade bonds and fixed income generally over equities. So I'd be happy with that on a relative basis.
Is the UK different to Europe, to the Eurozone? There's been big outperformance in the Eurozone recently. People are now starting to say, actually, versus the United States, we've run that race, and it's now time to get back to a more equal footing. Is that the right approach, and where does the UK fit into that?
Yeah, so I think the outperformance of the Eurozone will start to slow. There was a big benefit, I guess, from its exposure to the China reopening story, particularly on the consumer side through the luxury space, things like that.
Yep.
The UK market has exposure to China, but it's not through the consumer side, it's through the mining side, which is not the bit, obviously, that benefits from the reopening, or not in the first stages anyway. So I think the outperformance will start to slow as that wave is materialized, if you like. In terms of the US, do still struggle to see the US outperform at the moment, given that we are expecting earnings downgrades of around 7% for the course of this year in the US equity market.
Nice to see you. Thanks for stopping by, as ever. Great to see you. Caroline Simmons of UBS. This is Bloomberg. No clear narrative at an index level for Europe as we head into the close today. The DAX is down a little bit more than most. Buyer, one of the main factors behind that. We'll deal with the details in just a moment. The close is next. This is Bloomberg. To be honest, nothing to see here, at least at an index level. There's nothing really happening. DAX is down a bit, CAC's up a bit, FTSE's fairly flat. That's basically the narrative out of Europe today. I think the market's still trying to digest and figure out what's going on, to be honest. And we're still in the middle of earnings season, so I think single stocks, and I keep banging this drum, are the more important narrative. And that's basically the differentiator. Look at the DAX, it's down by 0.3%. Buyer's a big factor. The other thing I want to mention is it is Thursday. A lot of UK stocks go XD on a Thursday. That's what we're seeing today. But it's not just that. There's a whole load within the mining sector, the metals and mining sector that have gone XD as well today. Norsk Hydro being a name that stands out. So look, there you go. We're absolutely flat. 463. We've done nothing today. We've basically just gone sideways. Little dip, but basically we've recovered that. So as I say, nothing to see here. So let's move on and talk about the sector story, try and get an idea. And again, I think this is skewed. Basic resources down by 3.21. That's not real. That's ex-dividend. The luxury sector bouncing a little bit today. China's inflation data feeding into, I don't think so. Healthcare, real estate, travel and leisure, all moving up a little bit. Again, there's nothing really in there that kind of tells you a decent narrative. Maybe energy down by 2.05%. You have seen oil prices coming off a little bit today. Maybe that's a takeaway. Single stocks, though, I think probably a little bit more interesting. Rolls-Royce down by 6.05%. You have to appreciate the context of what is happening here. Rolls-Royce has had a mega surge this year. New management, new CEO, hoping to catch up with him at the Paris Air Show. I think they've got an AGM today. The stock is down by 6.05%. They're still cautious on what's happening with the supply chain. They're still cautious on what the story looks like going forward. They still are having to go through significant kind of reorganization, maybe just a bit of a reality check today. Man Group, female CEO. It is worth mentioning. I don't care what the share price has done today. Female CEO coming into what is a very storied institution. That is a significant moment for the finance sector. And there's Bayer. Weed killer is a factor here. The crop science business, what's happening in pharma. It's a pretty uninspiring set of numbers, pretty weak set of numbers, and what has been a pretty turbulent time, you could argue, for the current management team. And today, maybe that gets reflected in the share price, but that has dragged the German market down today. Let's talk about tomorrow. Let's talk about Friday. Always want to talk about Friday. What have we got coming up for you? You've got SocGen earnings. We are coming towards the end of earnings season, certainly for the banking sector. You get Richemont numbers as well. Luxury sector, what's happening in hard jewelry, worth paying attention to with the China narrative. Allianz out with their earnings. And we get the updated French and Spanish CPI numbers. I have to say, right now, Alex, that the ECB is sounding pretty hawkish, and maybe we'll get further evidence in the data for tomorrow. But the ECB, unlike the Bank of England, is looking significantly further out and potentially talking about rate hikes through the summer and into the autumn. Yep,
so let's pivot on that, because as you mentioned, you get that final read of French and Spanish CPI. So earlier today, the Bundesbank president and ECB Governing Council member Joachim Nagel said he's not ruling out future rate increases beyond the summer. He spoke to Bloomberg from the G7 finance ministers meeting in Japan.
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
All right, well, joining us now for more on this is Bloomberg's Jana Randau. Okay, Jana, September, on the table for a hike. Possible?
Definitely possible if the inflation data continue to surprise on the upside. We have seen quite a few surprises. Inflation in the Eurozone, of course, is still 7%. Core inflation is extremely sticky. Listening to the ECB chief economist, Philip Lane, earlier this week, he said there's a lot more momentum, especially in underlying inflation, in core inflation and food inflation. They're far from an all clear. And if we look at some of the data that have come in very recently, I think they just underline why they are concerned. We've seen the Consumer Expectations Survey today that puts inflation expectations on the consumer side at 5% 1 year out, at nearly 3% 3 years out. So that is not what a central bank with an inflation target of 2% wants to see.
Jana, the Fed might be done. The Bank of England almost signaled that it might be done today as well, but possibly we'll have maybe one more hike. It doesn't sound like it's certainly going to be extending its cycle into the autumn. Is the ECB really going to be able to go it alone?
If you ask an ECB policymaker, they will tell you, yes, of course, we are setting policy for the Eurozone, and we look at what central banks are, other central banks are doing, because obviously it will impact the economy, but ultimately the focus really is on inflation in the Eurozone. And they really have no reason to relax there. So we heard the president saying last week the ECB isn't done. She signaled at least 2 more hikes, June and July. That's what the market is nearly pricing. That's what economists are expecting. And we heard from quite a few people that that might not actually be enough. That this September hike, it looks like a very slim chance at the moment when you talk to economists and traders. But that hike might actually be necessary to anchor expectations to make sure inflation gets back.
So I appreciate that tomorrow's the final read of French and Spanish CPI. So it's not maybe like that game changing. However, what are you going to be looking for in some of the revisions based on the consumer inflation expectations you were just mentioning?
Yeah, so the final data usually comes with a lot more of a breakdown in the data, and so it will show us a little bit of where things are getting tighter, where things might be easing, and it's not just the inflation print, of course. Another thing we have a very close eye on is financing conditions. It's credit conditions, it's bank lending. That survey, the last one we saw, showed that banks are seeing demand for credit slowing very quickly, that credit conditions have tightened. So that clearly is a sign that the monetary policy tightening is showing some effect. And ultimately, also the expectation goes is that those tighter conditions will ultimately also impact inflation, but we haven't seen that yet. So that is something that policymakers will have a very close eye on, and we, of course, here as well, looking at how that tighter policy filters through the economy, financing conditions we've seen, the link to the real economy, that remains in the pipeline.
All right, Jana, thanks a lot. Really appreciate it. Bloomberg's Jana Rendau joining us there. Focus back to the U.S. for a moment. We did get a 4-week T-bill auction. Now, typically we don't break these, but 4 weeks kind of puts us in line with where we may be around the debt ceiling, so it's good to kind of keep a track of this. So on a bid-to-cover ratio, it actually came in really strong, but I take a look at the median discount rate, so that yield, 5.5%. That's bang in line with where it was just a couple weeks ago, but compared to where it was in April, it's a significant jump. Where we were in April was about 3.46%. So we're definitely getting investors coming in and buying, but at very high yields as the debt ceiling fear continues to creep in. All right, coming up, I like this. The winds of change for Vestas. As the Danish wind turbine maker returns to profit in the first quarter, we're going to have an exclusive interview with the CEO, Henrik Andersen, coming up next. This is Bloomberg. All right, Vestas Wind Systems, which makes wind turbines, posted first quarter earnings following an industry struggle with higher material costs. Now, Abigail Doolittle has been digging through some of the filings here, and she joins us with more. Abigail?
Well, the stock had started higher because, of course, they did turn a profit for the first time in several quarters. It ended a bit lower, the worst day in almost 2 months, but the fundamentals very strong. They put up their first profit again over the last couple of quarters. If we take a look at what has been happening more recently, we can see the bit of a shift, and it has everything to do, the struggle has to do with rising steel costs, material costs, supply chain issues, not just for Vestas, for other wind companies as well. So you can see all of these losses, but the first quarter profit, very positive. Vestas has also maintained their full year guidance, so that's a positive for investors. I suspect that the reason why the stock could be down today, if we take a look at Vestas relative to the